You know what's popular? ARMs. With the increase in fixed rate mortgage rates, more home buyers are now turning to adjustable rate mortgages, ARMs, as an attractive option, particularly those who are taking out loans over $1 million. According to recent data from CoreLogic, ARMs made up 18.6% of the total amount of conventional single-family mortgage loans originated, which is a significant rise from the 4% recorded in January of 21. Moreover, for mortgage loans exceeding $1 million, ARMs constituted 45% of the total amount borrowed, showing a 6% increase compared to the same period last year. So, what is an ARM? An adjustable rate mortgage is a type of home loan where the interest rate is not fixed for the entire loan term. Instead, the interest rate on an ARM can change periodically, typically after an initial fixed rate period. This fixed rate period is usually set at the beginning of the loan, ranging from a few months to several years, often 5 or 7 years. During the initial fixed rate period, the borrower enjoys a stable interest rate, which means their monthly mortgage payment remains consistent and predictable. However, once this period ends, the interest rate on an ARM is adjusted based on a specific financial index plus a margin set by the lender. The adjustment of the interest rate can occur at regular intervals, usually annually, or sometimes even more frequently, and depending on the terms of the mortgage. The rate can either increase or decrease depending on the movement of that chosen financial index. So, when the interest rate goes up, the borrower's monthly mortgage payment also increases. Conversely, when the interest rate goes down, the monthly payment decreases. So let's break it down. What are the benefits of an ARM? First of all, obviously, a lower initial interest rate. ARMs often start out with lower interest rates compared to fixed rate mortgages. This lower rate can result in more affordable initial monthly payments, make it easier for borrowers to qualify for a higher loan amount. Second, short-term savings. If you plan to own the property for a relatively short period, an ARM can save you money during that initial fixed rate period. You can take advantage of the lower introductory rate before selling the property or refinancing. And third, there's flexibility. ARMs provide flexibility in loan terms, including different initial fixed rate periods and adjustment intervals. Borrowers can choose an ARM that aligns with their specific financial goals and their timeline. And fourth, potential rate decreases. While ARMs carry the risk of rate increases, they also offer the potential for rate decreases. If market interest rates decline, your monthly payments go down during the subsequent adjustment period. And 5, the initial rate lock. During that initial fixed rate period, borrowers are protected from interest rate fluctuations, allowing them to budget and plan their finances with predictability. And 6, affordability for high-value properties. For borrowers seeking to finance higher-priced homes, ARMs can be a viable option. The lower initial interest rate may make it more feasible to afford a larger loan amount. And there's favorable rate caps. Many ARMs have rate caps that limit how much the interest rate can increase during each adjustment period and over the life of the loan. These caps provide some protection against drastic rate hikes. And also, 8, there's an early payoff option. ARMs can be suitable for borrowers who expect their income to increase significantly or those who anticipate receiving a substantial sum of money in the near future, let's say from an inheritance. If you can pay off the mortgage or refinance before the first rate adjustment, you can avoid potential rate increases. While ARMs are not all benefits, though, there are some disadvantages and some risks. So let's talk about what those are. First of all, the interest rate uncertainty. The fluctuating interest rates can lead to unpredictable monthly payments. Rate increases, we talked about that. Rising interest rates can result in higher monthly payments during the loan term. And 3, budgeting challenges. Variability in the payments can make budgeting more difficult, especially for those with a fixed income. So you really need to be careful on this one. And there is a little bit of a risk of payment shock because if there is a sudden rate increase, it can cause significant payment spikes, leading to financial stress. And then there's some long-term costs you need to consider. Over time, an ARM may cost more than a fixed-rate mortgage if the interest rates rise significantly. And the impact of the index fluctuations. Changes in the underlying financial index can affect the interest rate and payments. And there's refinancing risks. Future refinancing may be challenging or costly if rates rise or if you have financial circumstances that change significantly. And some ARMs have fees or prepayment penalties for early repayment or refinancing, so make sure you know what those are. And there is a lower consumer protection. ARMs may offer less consumer protection compared to like a fixed rate mortgage. So these are all things you need to consider along with market conditions. There's economic downturns can exacerbate financial strain if rates rise and property values decline simultaneously. It's super important to carefully evaluate your financial situation and consider potential scenarios when considering an ARM. Factors such as your income, risk tolerance, future plans, and expectations for interest rates should all be taken into account. Consulting with a qualified mortgage professional can help you make an informed decision about whether an ARM aligns with your unique needs and financial goals. And speaking of mortgage professionals, we work with one of the best. Reach out and we'd be happy to connect you with our preferred local mortgage lender.